All right, strap yourselves in because we are going deep into the UK autumn budget 2024. And yeah, after this deep dive, you'll be the one explaining it all to your colleagues. We've been poring over all the latest from Accounting WP, and let me tell you, it's a wild ride. It's a bit of a balancing act. The Chancellor's walking a tightrope here, trying to keep the public finances stable, all while trying to keep those promises she made before the election.
Yeah?
Sound interesting? Well, it should, because while it's true that taxes are going up, it's not going to affect everyone in the same way.
It's a real head-scratcher. Chancellor Reeves is dealing with a 22 billion pound shortfall. Some are calling it a black hole, basically. It's what she's inherited from the previous government. To fill that, she's got to find a way to raise a massive 40 billion pounds. But here's where it gets tricky. You remember all those promises made about not raising income tax and national insurance, or VAT for working people? Well, she's sticking to her guns on that. But that really ties her hands, doesn't it?
Yeah, that's what I don't get. So where's the money going to come from? What really jumps out is this huge hike in employers' national insurance.
All right.
Huge might even be an understatement. The rate for employers' national insurance is going all the way up to 15%. That's a 1.2 percentage point increase. Think about it. That's an additional cost for every single business, for every single employee. We could be talking about a whopping 20 billion pounds just from this one change.
Okay, so that takes care of a big chunk of what she needs. But hang on a second. Doesn't that completely contradict that whole promise about protecting working people?
Well, on the face of it, it does seem that way. Individual national insurance rates are staying right where they are. So in that sense, the promise is being kept. But you've got to think about the knock-on effect here. This is going to hit businesses right in the pocketbook. Small businesses are going to feel it the most. It might even force them to look at hiring fewer people, or even start looking into things like automation.
Right, I see what you mean. If their costs are going up, they've got to make changes somewhere. So are there any changes to the thresholds for paying employers' national insurance? Anything that could help them out a bit?
Well, there are a couple of tweaks. The threshold for paying employers' NI is going down to £5,000. But to balance that out, they are increasing the employment allowance. That's going up to £10,500. So if you're running a small business, you might be able to make up for some of that NI increase. It all depends on how much you're paying out in wages.
All right, so it's a bit of a give and take there. Let's be honest, though, most people aren't exactly glued to the budget day announcements. Employers' NI isn't exactly riveting stuff for most people. There are other changes, though, that people might miss, changes that could have a big impact, like how they've overhauled capital gains tax and inheritance tax.
You're spot on. Those aren't really the most exciting topics, but they're important, especially if you're thinking about investments or estate planning. So capital gains tax, or CGT for short, applies to the profit you make when you sell certain assets. Things like second homes, shares, even that antique you inherited. Both the higher and lower CGT rates are going up to 24% and 18% respectively.
So just to be clear, if I sold my grandma's old tea set and made some money off of it, I'd be giving a bigger chunk of that to the taxman.
That's exactly right. And it's not just about things like collectibles. It's going to affect anyone selling anything that's gone up in value. Then there's inheritance tax, or IHT. The freeze on the thresholds for that is staying put, meaning that more people's estates could end up having to pay this tax when their assets are passed down. Plus, there's this loophole they're closing. Inherited pensions used to be exempt, but from April 2025 onwards, they'll be brought under the IHT umbrella.
So even if you're not exactly rolling in it, these changes to CGT and IHT could still hit your pocket.
Especially when you start planning for the future.
And there's one more change that's causing a bit of a stir, the scrapping of the non-dom regime. Can you tell us a bit more about that? What was it, and why is it such a big deal?
The non-dom regime was this kind of quirky thing in the UK tax system. It meant that people who were living in the UK, but who considered their real home or domicile to be somewhere else, could potentially get away with not paying UK tax on their income and gains from outside the UK. So imagine someone who lives in London, but whose domicile is somewhere like Monaco. As long as they didn't bring their foreign earnings into the UK, they could often avoid paying UK tax on them.
So it was a way for some people, especially wealthy people, to live in the UK but potentially pay less in taxes.
Basically, yes. It was a pretty complicated system with all sorts of ifs and buts, and it always sparked debates about whether it was fair or not. Critics said it let wealthy people avoid contributing their fair share to the UK's tax system.
So that was what the non-dom regime was all about. What's changing now, and why is it such a big deal?
They're getting rid of the non-dom regime entirely. The new system's all about where you actually live, your residence rather than your domicile. So now if you're living in the UK, you're likely going to be taxed on all of your income, regardless of where your domicile might be.
So that's a pretty big shift. What kind of impact could this change have?
That's the million-dollar question. Some people say it's a question of fairness, closing a loophole that only really benefited the wealthy. They think it'll bring in more tax revenue. Others are worried it might make the UK less appealing to international talent and investment.
So it might make things simpler on paper. But the real-world effects are still uncertain. This budget is shaping up to be a real puzzle, with some unexpected winners and losers along the way.
Definitely. We've covered a lot of ground already, but we're just getting started. There's a lot more to unpack about how all of these changes will actually play out in the real world.
Right. There's still a lot to discuss. We'll be back in a moment to delve deeper into the Autumn Budget 2024. So we're back, and as we dig deeper into this budget, it feels like the government's trying to do two things at once, trying to balance the books while also trying to boost the economy. Can they really do both?
You've hit on something really fundamental in economics. There's this constant tension. Think of it like this. Imagine the UK economy is like a plant. It needs water and sunlight to grow. And the government's job is to make sure it gets enough of both. Raising revenue is like giving the plant water. It provides what's needed for essential public services. But if you give it too much water, the plant will drown. In the same way, if you raise taxes too much, you can stifle economic growth. That's why the government needs to create the right conditions for businesses to thrive, kind of like providing the plant with sunlight.
Okay, so that makes sense. So are some of the measures in this budget more like water and others more like sunlight?
Exactly. Take that increase in employers' national insurance. That's definitely more like watering the plant. It's a way to bring in some much-needed money, but it's also adding to the costs of doing business.
And that could mean businesses end up hiring fewer people or offering lower wages. That's not going to help the economy grow, is it?
It's all about finding the right balance. Imagine a restaurant owner have to suddenly pay more to employ their servers. They might have to reduce staff hours or even increase prices. That could have an impact beyond just the restaurant. It could affect the whole local economy.
So are there any other ways to raise revenue? Ways that wouldn't have this kind of knock-on effect on businesses?
Well, that's where you get a lot of debate amongst economists. Some say we need to broaden the tax base, maybe by closing loopholes that benefit specific groups, or by introducing new taxes on things like wealth or consumption. The idea is to spread the burden more evenly, which could reduce the impact on individual businesses.
So there's no simple answer, just different approaches.
Each with its own pros and cons.
What about the changes to capital gains tax and inheritance tax? Are those more about raising money or about influencing economic behavior?
That's a good question. It seems like those changes are really focused on those with higher incomes. Take the increase in capital gains tax, for example. Say you put money into a tech startup a few years ago, and now you're selling your shares for a nice profit. The higher CGT rate means you're giving a bigger chunk of that profit to the taxman.
So they're trying to get more revenue from those who are already well off.
That's one way to look at it. But it could also discourage investment. If people know they'll be taxed more on their profits, they might be less likely to take risks, especially in areas like startups or sectors with high growth potential, and that could have a negative impact on innovation.
It's a bit like a game of chess.
Every move you make has consequences further down the line.
What about the inheritance tax changes? Could those backfire in some way?
There's definitely a chance of that. Remember, they're keeping the freeze on the thresholds, and they're bringing inherited pensions into the IHT net. So imagine a family-owned business that gets passed down to the next generation. If they suddenly get hit with a huge inheritance tax bill, they might be forced to sell assets to cover it, maybe even parts of the business itself.
And that could really disrupt successful businesses.
I think it even lead to job losses.
Trying to figure out what the long-term impact of all this will be is a bit like looking into a crystal ball, isn't it?
It really is. There's so many different factors at play. It's impossible to say for sure what will happen in the end. That's why economists have such heated debates about these things. There's rarely a clear-cut answer.
It's like we're watching this huge economic experiment unfold in real time. And speaking of experiments, what about that investment in HMRC? It seems a bit strange, doesn't it? Spending money to hopefully collect more money?
It's definitely a risk, but it's a calculated one. Think of it this way. If HMRC's got better systems and more resources, they can do a better job of catching tax evaders and closing those loopholes. And that could bring in a lot of revenue. But of course, it's not free. You need money to modernize their systems, to recruit more staff, to put those new enfranchisement measures in place.
So it's a gamble, but one the government's willing to take. But even with a more efficient HMRC, can we really solve the UK's economic challenges just by collecting more taxes?
That's where things get even more complicated. It's not just about collecting money, it's about how you spend it. Are they investing in the right areas? Areas that will lead to long-term growth? Are they putting in place the right incentives? Incentives that encourage innovation and entrepreneurship.
So it's not just about balancing the books, it's about investing wisely in the future.
Exactly. It's like planning a long road trip. You need to make sure you have enough fuel to get where you're going, but you also need to choose the right route, pack the right things, and be ready for any unexpected detours along the way.
It seems like this budget is highlighting that balancing act that governments have to do.
Managing the needs of today while also trying to steer the economy in the right direction for the future.
We haven't even talked about those positive things you mentioned, the measures designed to help businesses and get the economy growing.
You're right, there are definitely some positive developments to discuss, especially for businesses. Let's have a look at those next.
And we're back for the final part of our deep dive into the autumn budget. We've talked about tax hikes and the government's Economic Balancing Act, but we've saved a big one for last. That scrapping of the non-dom regime, it sounds pretty technical, but the implications could be huge.
Yeah, you're right. This isn't just some minor change, it's a massive shift, one that could really change how the UK attracts international talent and investment.
So let's try to break this down. What exactly was the non-dom regime, and why was it so controversial?
Okay, so picture this. You're a successful entrepreneur. You made a fortune in tech, let's say, but you made it overseas. Now you want to live in the UK. Under the old non-dom regime, you could get away with not paying UK tax on your foreign income and gains. As long as you didn't bring that money into the UK, it all hinged on your domicile, which is basically your permanent home, even if you're actually living in the UK.
So you could live in London but have your financial home base somewhere else and potentially pay less UK tax.
Exactly. It was a pretty complicated system, though, lots of rules and conditions, and it always stirred up debate about fairness. Critics said it was a way for wealthy individuals to avoid paying their fair share.
Okay, so that's what the non-dom regime was. What's changing now, and why is it such a big deal?
Well, they're getting rid of it completely. No more non-dom regime. The new system is focused on residence, not domicile. So if you're living in the UK, you'll be taxed on all your income. No matter where your permanent home is, it definitely simplifies things, but it could have some major consequences.
So it sounds like they're closing a door that was open to some wealthy individuals. What kind of ripple effects could this have?
That's the big question, isn't it? It could make the UK tax system seem fairer, and it could bring in more revenue. But on the other hand, some people worry it might discourage wealthy individuals and entrepreneurs from coming to the UK, from investing here.
It's a gamble then. The government wants more tax revenue, but they risk losing the economic activity and investment these individuals could bring.
It's a trade-off for sure.
It really shows how tricky it is to balance fairness with staying competitive globally.
You hit the nail on the head. And it's not like we'll see the impact right away. We'll have to wait and see how this plays out over time.
It's just one piece of the puzzle that is this autumn budget.
It's a pretty complex puzzle.
We've covered so much. The balancing act of public finances, the potential impact of all these tax changes, the government's attempts to stimulate growth. We've even touched on the role of government in creating a sustainable economic future. It's a lot to take in.
It is, but that's what a deep dive is all about, isn't it?
It is. We've gone beyond the headlines to really understand the nuances of this budget.
And it's clear there are no easy answers when it comes to economics.
Definitely not.
So if there's one thing you want our listeners to remember, what would it be?
I think the most important thing to remember is that this budget is more than just numbers. It's a reflection of the challenges and opportunities facing the UK, and the choices the government is making to address them. The real effects of those choices will unfold over time. So stay informed, stay engaged, and keep asking questions.
That's some great advice. A huge thank you to our expert for guiding us through this deep dive into the UK's Autumn Budget 2024. If you want to explore this further, be sure to check out the full articles over at Accounting WA. Until next time, happy learning.